Hello, everyone, and welcome to another episode of Selling Greenville, your favorite real estate podcast here in Greenville, South Carolina. I'm your host, as always, Stan McCune. I'm a realtor right here in Greenville, and you can find all of my contact information in the show notes if you need to reach out to me for any and all of your local real estate needs. And just a reminder, as always, please rate, review, subscribe, download episodes, any of those things for the show. It just takes a little click, but it helps to support the show. And that is pretty much the only thing I ask of you guys, my listeners. But I do appreciate you guys listening. Or if you're watching on YouTube, remember, you can find this Selling Greenville podcast. Search for that on YouTube. You can find me on there. This is a good episode to watch because I'm going to be showing you a lot of data today. Because today we're going to be going over the Greater Greenville Association Realtors market stats for the month of March. They just released these a couple of days ago, a little bit later than they normally do. And so because of that, that's why I'm doing this episode a little bit later than I normally do. But I wanted to go ahead and go over this data because there is some interesting stuff to discuss in here. So if you're watching on YouTube, you will be able to actually see the actual charts and graphs that I'm looking at. And if you're listening, I'll try to make it to where you can still follow along like I always do. We're going to start right at the top with the new listings data. And by the way, I normally have my phone on silent. I have it on vibrate this time, strictly for the reason that I'm expecting a phone call and it may come through while I'm doing this. So this may be a situation where I have to pause the show and then come back or something like that. We'll see how that goes. Hopefully I just won't be interrupted. I can just go straight through these stats without any interruption, but I wanted to let you guys know that just in case. All right, so new listings data. New listings data, if we go all the way back to October, that was when we kind of turned the corner, right? From when the market was really reacting so strongly to the mortgage rates going up. We had new listings reach a all-time record in 2022. It's never been anywhere close to that ever since the summer of 2022, and then it had a precipitous fall off for the remainder of that year as rates just really skyrocketed in comparison to where they had been. Now, we have seen basically supply and demand kind of stabilize until then. This past year, 2023, we saw a very strange pattern where normally we have a standard peak type of pattern that we have where new listings go up as you get to the summer. Your summer months are the months where the most new listings are coming on the market. That's because the most number of people are moving. That's not just a bunch of sellers. Usually the sellers are also buyers in this market. But what happened last year was really weird, where we had basically the new listings data stabilized around the same time, basically in March of last year. And they hit almost 2,000, and then they dropped down to the 1,700 range, and then went back up into the 1,900 range, and then stayed up there, then went back into the 1,700 range, and back up to the 1,900 range, and it created this weird like crown-like pattern in the data that I have not seen before. And so what is going to be interesting to see is if something like that continues this year. Thus far, I don't see any indicators in the data that that's going to happen, but we are still too early. So here is where we're at. After October, as I started to say, of last year, we finally saw things start to stabilize. People finally come to grips with the fact, okay, these high mortgage rates are kind of here to stay. And so after many, many months of new listings year on year being lower from obviously from the prior year, we started to see some positive prints. In October, new listings was up 9.5% over the prior year. In November, 16.4%. December, 10.4%. January, 32.3%. February, 24.8%. So we've had some very high double-digit year-on-year new listings prints. And that really, now that we're comparing to the months when things were a lot higher in 2023, now the year-on-year data looks a lot more stable. So what happened in March of this year was the new listings were up only 1.5% year on year. That's the lowest number since September of last year when it was negative 10.4%. If you're really interested, it's 1,991 new listings. Was what we had in March of 2024. And that compares very favorably, again, to March 23, which was 1,961. Very, very similar, a very slight increase. And so what does that tell me? Again, that tells me that we've seen stabilization in the market. This is just kind of where things are. And it also tells me that essentially we can expect the market to be pretty similar right now to what it was last year around this time. And that is what it is. I mentioned last time we talked about this data that I was busy. That busyness has remained for me and for many others. And so even though it's a suppressed market in many ways, there's still a lot of stuff happening. Pending sales. Pending sales, this is homes that go under contract in a given month. It's always inaccurate for the most recent months, so we've got to look back 2 months, all the way back to February. Now, when we discussed this last month, I said that I thought that February would end up being in the low 1200s after it was revised. Well, it ended up getting revised into the high 1200s, so 1,280, which was only a slight dip from January, which was a pretty high January in comparison to most years. But that 1,280 is basically flat from February 2023 when it was 1,282 new listings. And if you're watching on YouTube, you can see that I actually circled, going back to 2016, all of the February data going back then. You can see how basically since 2016, the pending sales were essentially rising a little bit every year up until 2021. In 2021, that was the peak March pending sales number. And then 2022, it started to drop down. And then 2023, it dropped down even more. And now we're essentially flat. So we maybe kind of found that bottom because we're still slightly higher than 2019, but we're essentially right back on par with where 2020 was. And remember, February of 2020 was before the pandemic. That was kind of the last normal month. So we have kind of gone back to what demand was back then, is one way of interpreting this data. Closed sales was down 3.7% year on year, 1,378 closed sales in comparison to 1,431 the year before. No big conclusions from that. We had a massive March last year that just kind of came out of the blue. You can see this on the chart, how it just skyrocketed in March. And then last year it went back down in April, and then we had a few good months in the summer. So it was kind of a weird year last year. Based on the data that I'm seeing here. Actually, let me go back to pending sales for a second because this informs closed sales. So the March number of pending sales is definitely, obviously low. This number is usually around 400 or so below what it should be. Well, March of 2023 had 1,521 pending sales, which didn't really impact April too much in terms of the closed sales. It impacted more May and June. But we are definitely going to see, if I had to predict right now, once this data gets revised, the pending sales for March of this year are going to be really quite a bit down from what they were last year. Probably, we'll probably see a print close to 1,400 in comparison to 1,521 of March in 2023. So that'll be interesting to track. That being said, that March of 2023, like I said, was really an anomaly. It was like we had all this pent up demand from basically the fourth quarter of that year into the first 2 months of 2023, and then things kind of started to stabilize a little bit. So our closed sales for the month of March was down. In terms of whether our closed sales will continue to be down, I think that probably April's closed sales will probably compare pretty favorably to 2023. We might even see a positive year on year for April. I'm guessing that May and June will probably be down a little bit as a result of our pending sales in March being down. The pending sales, you think about a real estate transaction, typically from the time a home goes under contract until the time it closes is about a month. But in terms of looking at this data, because you have to account for contracts falling through and some of this, some of the March data might be from the end of March. A lot of this spills over. The pending sales for March will result in a lot of May and even June closings. So that's what I'm thinking is happening there. So we had a down month for March. I think we'll probably have an up month for April in terms of closed sales, and then we might see some down months in May and June as we track this data. Days on market until sale. This was one that last time we talked about this. I actually went back to listen to it because I couldn't remember exactly what I said. I said that I thought we might see days on market until sale go into the 60s, but I said I wasn't willing to predict that because I had predicted that last year and was wrong. Well, I'm glad I didn't predict that because days on market until sale dropped back down both month on month and year on year, down to 54 for the month of March. It was 58 days on market until sale in March 2023. So homes are selling faster in the month of March than they were both March of last year and in February of this year as well. So that's very interesting. Also, if you're looking on YouTube, I annotated this chart to show what has happened with days on market until sale. So we saw basically from 2017 until 2020, the month of March was pretty stable. It was hovering right around 60 very consistently, even in 2020. Of course, that was the COVID year. It started to get up a little bit above 60, and then it really went way down. And this, again, these are anomalies. 2021 was real low. 2022 was super low. And then it shot way up in 2023. And now it's coming back down again in 2024. Here's the other thing I want to point out with this data is that many, many years, March is the highest days on market until sale month of the year. Now, we've had some very weird, obviously, data trends the past several years. We had a pandemic, and then we had weird mortgage rate impacts, both then and now. But if this pattern holds, and I think there's a very good chance it does, then the highest days on market until sale number may end up being that 57 print from February. And so, long story short, it's looking like this year homes are going to sell faster than they did last year, which is, if that seems counterintuitive, it is kind of counterintuitive, right? I have said, and I've gone on the record saying, and I'm not ashamed for saying it, that the market is weird right now. But you know what? There's a lot of homes that are that are having to experience price drops. We just talked about that. A lot of homes that are being withdrawn. So not everything is, you can't extrapolate a ton from this data. But long story short, it's not, homes that are on the market, generally speaking, are not taking as long to sell as they did last year at this time. Now, this is the first negative year-on-year print that we have had in a very long time. I mean, you can, if you're watching on YouTube, you can look back on the data. We had our first 0% increase last year, last month, February, when it stayed at 57 days, and now we're seeing it come back down. So if this gains steam, this could be an indication that demand is actually starting to build. And I will say that so far in April, as we're almost at the end of April here, there's definitely demand out there. Now that people are picky, but there's a lot of people out there looking and people willing to jump on something if it makes sense for them. And so we'll have to keep track on that. But I mean, it's looking like if standard trends hold, we'll be potentially back down into the 40s for days on market, which is very, very low, right? We don't typically see in the 40s. In fact, this whole data that we're looking at, we never saw it go below 40 until the year 2020. And so to see that happen again this year would be quite a surprise. But again, this is the strange dynamic that we have in the market right now, where even though demand is so suppressed in comparison to what it could be, it is still propping up. There's still enough demand in the Greenville market to prop up a lot of these numbers. Now, imagine if mortgage rates started to go down, how much demand would go bonkers. Because I'll say, it's worth saying, in case you haven't been paying attention, mortgage rates are really high right now. Let's talk about that for a second. The 10-year yield right now is at 4.611. That is very, very high in comparison to what it had been, not that long ago. I mean, it was 4.19 let's see here, just back at the end of March. It was, if we go back even further, the beginning of February, it was 3.86. And that 10-year yield number is the closest correlation that we have to the 30-year fixed mortgage that is out there. So what is the 30-year fixed rate mortgage at, according to Mortgage News Daily, which tends to skew high, but it's a good tracker to look at. It's at 7.43. Now, my clients, generally speaking, if they have good credit, they're getting pre-approved for rates much, much lower than that. But that is the Mortgage News Daily rate currently, 7.43%. So that's a really, really high number, right? That is near record highs since basically 2012, essentially. And so that is something to keep in mind, is that if that were to go consistently below 7%, and I'm aware that I predicted that it would be below 7% for the entire year. I was wrong, okay? I was wrong about that one. But now we're seeing, based on what demand is right now, it feels soft, but imagine what it would have been. There is a ton of pent-up demand right now that is just waiting for the dam to be unleashed, and mortgage rates are the only thing keeping that dam open right now. And so keep that in mind. This is going to be a weird year. Some people now are saying that we might not see the Fed drop rates at all the entire year. And so that's very interesting. It's not what the Fed is saying, but people are starting to realize that that's a possibility. Now, interestingly, when is this little dust up with Israel and Iran, I'm not trying to trivialize it by calling it a dust up, but I don't really know what else to call it. It's not really a war, strikes between the countries. When that happened, it actually brought the 10-year yield down a little bit, because people started buying treasuries and bonds and whatnot in anticipation of a potential war. So one thing to think about as well is that if we have more global conflicts, that actually could indirectly bring mortgage rates down. Very, very weird world that we live in. Everything is backwards and upside down and all of that. But I'm not a social commentator. I am a real estate agent who analyzes this data, and I'm just telling you what I see. All right, let's talk about the median sales price. It hopped back up into the 300s. Remember last month we saw a print at 299.9, our first sub 300,000 print in a while, but that was still a year-on-year increase. Well, March, it hopped back up to 311,000, which was a 3.7% increase from the 299.9 print from March of 2023. So we are back into the 300s. Now, if history is indicative, we will never, ever see a print below 300,000 again. Okay? We'll see if that holds. But if history is indicative of what normally happens, so and what do I mean by that? Normally, March is not the normally March is near the low point of the year, and so you look at history. Usually, the end of the year ends up substantially higher than March. There are a few anomalies. 2018 was a year that was an anomaly. You could find some others if you really scroll through this data. But generally speaking, if historical norms end up being true, gone are the days of a median in the greater Greenville area of less than 300,000. So right now, the median is 311,000. If you want to look at the average is 369,700, which is also an increase, a 6.5% year-on-year increase from the 347,000 of March 2023. Percent of list price received, another indicator that demand is still staying stable and perhaps even ramping up right now. We had a 0.3% increase in March, and so that took us up to and a 0.3% increase year on year. And so that took us up to 98.6%. So now sellers are, really experiencing the benefit of this time of year where they're able to get a higher percentage for their home for what it's listed than other times of the year. And again, if history is indicative, it will stay at this level, maybe even go up a little bit for the next couple of months. And so generally speaking, again, this doesn't account for concessions, price reductions, things like that. But generally speaking, sellers are getting over 98% of what they have a home listed for once it sells, not accounting for seller concessions, not accounting for whether they have dropped the price during that time. I'm going to skip the housing affordability index I discussed last time. I don't know what's going on with that. I'm not going to pretend like I do. Now here's inventory of homes for sale, which is another metric that I think is kind of would lead you to believe that demand is weakening. But I don't think we can say demand is weakening. I think that what we can say is that more people are listing their homes. We're seeing people listing homes. We're seeing examples of people listing homes that they are when they're not having to buy a home. Okay, so investors, people like that that have real estate that they want to sell right now for whatever reason, and that they don't immediately have another home to purchase. So inventory, this is a number that's always wrong for the most recent month. So I'm not going to really look at the March numbers. Those are meaningless. But what we will look at is that February took a big jump actually from February 2023, a 21.6% jump. That's the largest jump since May of last year. So a huge jump. So the inventory of homes for sale at the end of February is 3,598, up from 2,959 February 2023. And we have been just kind of bouncing around really close to what it was pre-pandemic. We're still a little bit below that, but based on the preliminary March number of 4,215, which is definitely going to get revised down. This one's also usually about 400 to 500 higher than it should be. We are going to still continue to see this rise. And so we could very well see, once this March number gets revised, it could be in that 37 to 3,800 range, which would put us honestly right in there with normal pre-pandemic numbers. And so it's interesting because some of this data is looking a little bit more normal and some of it is looking very much not normal. So the inventory of homes for sale, I think what we can say is that there are basically two types of homes right now. There's homes that are listing and then just sitting, and they're adding to this inventory. And then there's a lot of the homes that aren't just sitting are going under contract very, very quickly. And that's why the days on market is coming down a bit and is kind of historically low. Some of these other metrics, that's why prices are still going up on a meta level. But that's what I think is happening that explains some of this seemingly contradictory data. Month supply for the month of February went up from 2.3 in 2023 to 2.8 in February 2024. Once this number for March gets revised, it'll probably be, ticking up there. It might go up to 2.9 or might go up to 3. Again, those numbers are all still pretty low numbers at the end of the day. Typically, historically, we would expect to see this basically between 3.5 and 5, usually around like 4 months of inventory, something like that. But we are not there yet. This is still a number very indicative of a seller's market. Of course, I'm not paying much attention to the March number because the March number divides divides inventory by pending sales. And I've already said both of those numbers are frequently wrong and get heavily revised. So I think March is going to come in at 2.9 or 3 months of inventory probably once this is all said and done. That's still going to be a massive increase from March of 23 was only 2.3 months, similar to what February was. So we're seeing a little bit of softening for buyers, but not enough softening to see meaningful metrics, meaningful changes in prices, meaningful changes, or at least in the positive for buyers. Prices still going up. We're not seeing meaningful help for buyers in terms of days on market, all of these things. But if this really started to soften, and if we reached a point where months on inventory was starting to get closer to 4, that would really start to soften some of these other numbers for buyers. But I just don't know that that's going to happen because, again, where is the inventory going to come from? There's no clear indication of exactly where that's going to come from. And again, rates are probably pretty close to their highest. I'd be, granted, I don't have a great track record with predicting where these rates are going to go. Still figuring that out. But I would be pretty surprised if the Mortgage News Daily rate, ever, if we saw it here in the future exceed, let's say 7.6. I'd be surprised if it exceeds 7.6. I think if some of the inflation data, I think we've got some inflation data coming out this week. If some of that doesn't seem particularly good, I think we could see this rate hop back up, into the 7.5s. I'd be surprised if it hopped back up into the 7.6s. So that will be something that we'll have to track. But that would be really the main thing that would cause the market to really soften up more, is if rates just started to just creep back up again and started to get closer to 8%. Right now, I think they're pretty close to their peak, but we'll have to see. It's not something, it's really hard to predict. I have seen so many different models out there trying to predict what's going to happen with rates and the market and whatnot, and almost all of them have been wrong. Almost every single one of them. I even saw one recently, just a few weeks ago, that said that they are still pricing in 6 rate cuts this year from the Fed. Well, I mean, we're almost at the point now where if they cut rates by, and this was basically a 150 basis point rate cut. So that would be, 25. You could do it a few different ways. They could have a month where they cut by 50 or 75 or whatever. But normally, most people don't think that the Fed is going to cut when they start cutting more than 25 basis points at a time. And so I mean, to do that, to get to 150, they would have to cut 6 different times. So that they would, at the very least, have to start cutting in July, and then would have to cut every single month by 25 basis points until the end of the year. I just don't see that happening right now unless this inflation data completely shatters everyone's predictions. Everyone thinks the inflation data is going to come in hot, and I do too. I mean, until I see something in the data that makes me think it's not going to come in hot, I'm going to assume it's going to keep coming in hot, and that's going to keep rates elevated. Now, what's interesting is a lot of inflation data in other countries, including like Canada, some other places that kind of mirror the U.S., is a lot softer than the U.S. The labor market in the U.S. is just strong, and consumption is shockingly strong. So I don't know what exactly to make of that. You wouldn't think that our data would be so much different than Canada's data. Now, some people are, they want to say that, the books are being cooked because it's an election year, and they're going to wait until closer to the election to cut rates. I don't think the Fed cares at all about the fact that it's an election. Well, the Fed chairman, he wants to stay chairman. He doesn't want a new president to come in or for, Biden to get upset and relieve him of his duties. He doesn't care. He could listen. Most Fed chairs, they don't stay for the entire length of their term because they can make more money in the private markets. They have to exclude themselves from so many things in the market because they could do so much insider trading. They're taking a pay cut actually to serve on the Fed. Every one of those Fed governors and presidents have to do that. That's why very few of them serve for longer than 4 to 6 years, even though they could serve for, I believe the term is 12 years. So I don't buy that at all. I don't think that the election year has any sway on the Fed from what I have seen. Now, maybe if they're really, really staunch supporters of one party or another, perhaps. But from my perspective looking in, I don't think that. And reminder that the current Fed chairman was appointed by Donald Trump, and President Biden retained him. So I would not think that he would have a preference for one president versus the other. But that's just me rambling at this point. I didn't come in here with any particular notes outside of that, all of those data that we just went through. But I hope that was helpful for you guys. I hope you appreciated that. We have a lot more coming up here. I'm actually going to DC for a political conference here in a few weeks. That'll be fun. Hopefully, I have some information to share with you guys from that. Been doing a lot of interviews with politicians. For those of you that don't know, I'm heavily involved in our local political scene. Some interesting stuff that's come out of that. I'm sure I'll have some things to share with you guys about that at some point. But that's all for today's episode. Thank you guys for listening as always. Please like, rate, review, subscribe, comment, download episodes, all of those good things. Just take a moment to do that. All of my contact information is in the show notes if you need a realtor for any of your real estate needs here in the Greenville area. We will talk again next time.